Good afternoon. Today's Pacific West Mortgage Fund podcast is brought to you by the Granger Company, a full-service commercial real estate company specializing in property management, leasing, and sales of commercial property in the Southern California marketplace. I'm very excited today to have a special guest, Kim, at Fortra Law. We've used Kevin for many, many years for a lot of our syndication work. Today's podcast is Other People's Money. We're going to be talking about how to raise money, how to keep yourself out of trouble. From everything, I think we're really going to be talking about everything from very small deals, Kevin, to larger transactions. Yep. Kevin has been working in this area for, how long have I known you? For at least 10 years.
At least 10 years now. Yeah. I've been at the firm now 12 years, going on 13. So, yeah.
So Kevin did all of our operating agreements, what are these? PPMs,
Private Placement Memorandum.
Private Placement Memorandums, thank you. And LLC documents, those types of things. So, Kevin, let me kick this off, little thought experiment, if we can. I'm a broker.
Okay.
I just found the most beautiful piece of property. Yep. It's a $2 million deal. I've got $200,000 in the bank. Mm-hmm. I need to bring in 5 to 10 partners. Mm-hmm. How would you handle that scenario?
Well, I mean, ultimately, it's the client's decision to structure. But if I'm the one structuring it, typically, you're going to go out and raise the equity, right? And so you're going to find financing from a lender like yourself, but you're also going to need to come with equity to be able to afford the down payment.
So in our scenario, let's just say that I'm trying to raise 50% of it. I'm trying to raise $1 million.
Right. So typically speaking, if a builder or developer or an investor wants to go out and raise some money for their project, they'll start syndicating. Syndicating means you have an identified asset. You're going to raise money, usually equity, around that project to fund that project. And ultimately, the investors will earn a return on investment after the property has been stabilized and sold or rented or whatever have you. Generally speaking, we're going to be starting with very simple structures because why complicate it? So if it's a small group of 5 people, hopefully they're all accredited investors that will keep the legal kind of costs down a little bit.
Okay, so let's talk about that for a second. We're going to dig into a lot of the sort of nuances here, but there is a difference between accredited and non-accredited,
correct,
which we will get into. But just why don't you walk us through that? I guess we can revisit that, but we do need to talk about that.
For sure, yeah. And so hopefully they're focusing on high net worth accredited investors, which will keep their legal costs down, because technically speaking, with a small group of investors where you've got a well-established relationship with them, you don't necessarily need a private placement memorandum. For 5 people, give or take, I'm not a huge advocate for doing an offering like that without one, but you can do it without one. And typically speaking, you're going to set up an LLC to buy the property. The investors will become members of that LLC. You will also be a member of that LLC, but you'll also be the manager of that LLC.
So that's what you call a managing member, is that
correct,
right?
Managing member or just a manager, right? Either way you want to set it up. And typically speaking, the investors will be passive, right? They're going to be relying on you, the broker, or you, the originator, you, the manager of the project, to raise the money, but also manage the project well and get it to a place where it's profitable and producing returns for the investors, and hopefully a good exit for them so they can benefit from that investment. The idea behind syndication for your first time kind of operator is keep it as simple as possible, to keep it as small as possible, and to keep it really easy to manage, right? So an LLC is ideal because it's really easy to account for. It's really easy to set up. You know, the structure that I'm referencing, all you really need is an operating agreement, mm-hmm, either some kind of subscription agreement or some kind of joinder agreement, and a basic securities filing. And that will be kind of the bread and butter for a lot of real estate investors out there. As that progresses, as the group needs to become larger because the deal sizes get bigger, the likelihood is you will definitely need that private placement memorandum. You will likely need a lot more complicated structures. And then you'll also probably need to think about national securities compliance as opposed to like local state level mm-hmm compliance. And that's where we typically talk with clients about expanding their footprint, both on the capital raise side, but also on the asset side. And we'll structure the deals in a much more kind of structured rinse and repeat approach. So the client can have I would say, comfort knowing that they can get their syndications done quickly, but they're done correct, and they're using a law firm for it. So they can have comfort that a law firm is guiding them through it.
Right, exactly. So I want to just back up just a second, because when I first started syndicating property, this was back, when dinosaurs still roamed the earth, at least small ones, and they had what was called a 25103F, which was a subchapter of the state of California. Was that Department of Corporations?
Back then it was, yeah. Back then it was.
So does that still exist?
It does. It does.
So that's for intrastate,
in California.
In California investors only.
Correct.
It was sort of referred to back when I was doing it as the friends and family.
It still is, yeah.
And it was sort of the most simple structure because remember, listeners, and Kevin, you can tell us more about this, but when you get into these syndications, you are selling a security.
Correct.
And this is a tricky area to be in. And one reason that you probably don't want to be doing this sort of on the back of a napkin is because if things go sideways, if somebody gets unhappy, you want to make sure as the managing member or syndicator, the lead person on this thing, that you are limiting your exposure.
Oh, yeah.
And that's why you want to get into handling the securitization of these assets correctly.
Correct. I mean, the liability, I've seen so many times, law of large numbers. People come in, they go to a seminar, they hear the wrong information. Oh yeah, I can do it with this basic form set and not think about securities laws. And one of the worst things they can do is they set it up wrong. They have the operating agreement's not written correctly, or they're raising money from non-accredited investors and they have no PPM. They are marketing this thing publicly. It's all kinds of mistakes happening. And what they don't realize is that the SEC is not just the SEC actually, to your point, the California regulators too, the Department of Financial Protection and Innovation, that's their new name, they are the California securities regulator. And they are actually surprisingly more aggressive than the SEC is.
That's what I've found with the state of California.
Yeah, and many states are the same way, Washington, Colorado. So you really don't want to mess around with any level of securities exposure because frankly, the way it plays out with a securities regulator, their first reaction is going to be send you a subpoena asking you about everything. We call it kind of everything under the sun subpoena.
Right, exactly.
And you're just stressing out for no reason, and you shouldn't have been there to begin with. All you have to do is call an attorney.
Okay, so before we jump into why this is this pretty gnarly thing to be doing unless you're doing it really right, we've got the intrastate, which is the 25103F as in Frank, or we can go the SEC route,
Correct.
Which is, I understand it, just correct me if I'm wrong, but that's what's a Regulation D, subchapter B or C, and these are carve-outs on the public security process. Is that accurate?
Correct. So there's a whole framework of exemptions from registration. So the general rule is that if you're offering a security, you must be registered or be exempt. 99.9% of the time in real estate, people are exempt.
Okay, can I just interrupt you? When you say registered, that is a registered publicly traded security? Is that what you mean by that?
You are registered with the SEC or the state, and you are allowed to raise money from the public, and you have the option to go and trade your security on some exchange, whether it be the OTC, NASDAQ, NYSE. You have the option to do that. You don't have to do that, but you are registered with the government. In real estate, because of the nature of real estate being illiquid, the general populace is not the target investor. Typically, the high net worth investor is, or the family office is.
Okay, so you've brought that term up, accredited investor.
Yeah.
Versus, I guess, what we would call a non-accredited investor. An accredited investor is, quote unquote, a high net worth individual. Generally speaking, the qualifications are what? You have to have...
So for an individual, the definition of an accredited investor is they either have $1 million net worth less the primary home, or they have an annual adjusted gross income of $200,000 per year for the past 2 years, or for husband and wife, $300,000 per year.
Okay.
But there's other qualifications. If you're an entity, the entity itself has $5 million in assets, or the individual owners of that entity are individually accredited under that last definition. And if you're a trust, the trust has $5 million or more in assets. So there's a lot of ways to qualify as unaccredited. And all of these exemptions are built around this type of investor. The position of the regulators is that high net worth investors are not the people that we're trying to protect. We're trying to protect the school teacher that puts her nest egg into, a fraudulent offering and loses her shirt, right?
Yep.
That's what the government is trying to protect against. So they've deemed that offerings that concentrate on accredited investors are exempt from registration, and they have all these other rules about
the theory is that those people are sophisticated enough.
Correct.
They've done enough types of this business. They understand, how to analyze these things themselves. They're not relying on the person that's promoting them, et cetera, et cetera.
Correct, and typically also that they have enough of a net worth where even if they were to take a loss, they would not be that injured. Now, the problem, my perspective, is that the SEC's position on this is they're slowly adding features to it over the years, like minor little features that don't really move the needle for us. And so what they're not realizing is, wait, you could easily make this about sophistication. And so they are slowly going in that direction.
Yeah, my understanding is that the process of raising money, particularly, I think, correct me if I'm wrong, but I think during the Barack Obama period presidency, that they really loosened up
Correct.
the process of raising money. But let me jump back, because when I first started Pacific West Mortgage Fund, we started as an intrastate within California investors only. Our regulator at that time was the Department of Corporations, and then it was anyway. That's not important. But
DOC, DBO, now
yeah,
DFPI,
they kept changing and changing.
Yep.
But when we did our intrastate, the advantage was that the threshold for the investor was only $65,000 in earnings, or I think it was like $250,000 net worth, and you could advertise.
Correct. What's not understood about that, what you guys were doing, we call that a permit offering, right?
Right, exactly. And I was just going to finish by saying, however, you had to apply to the state of California annually for a permit, and the fund had to be audited, which is something we're going to talk about in a minute. But the SEC filing, which is a national filing, we have a Reg B and a Reg C. These are subchapters. With the B, you cannot advertise.
Correct.
You have to do it by knowing your investors through relationships, either business relationships or, friends of friends or whatever the arrangement is. However, with a C, and we're getting into the weeds just a little bit.
It's important, though. It's fine. Yeah.
The thing about this is that when you get into these subchapters, the important thing when you're talking the fund, the person that's out trying to raise money, they have to understand that there's lots of avenues on these exemptions, and they offer different advantages and disadvantages.
Correct.
So, for example, with the B versus the C, the B, the accredited investors are self-accredited. With the C, correct me if I'm wrong, but the C, you have to get an independent accreditor.
So that rule has evolved recently. So under 506B, as in Bravo, that exemption says the accrediteds that come in, because you're not allowed to advertise, right? So that gives you a little bit more. The government's like, well, you're not publicly offering this thing. We'll let you operate a little more loosely. And so what they've said is, if the accredited investor says, I am accredited, self-representation, that's fine as long as you don't have any reasonable belief that they're not, right?
Like them and they live in the trailer park or something down the street.
If you know for a fact this guy drives a Pinto and he works at McDonald's, you probably shouldn't say no, right? When 506C came out, this was part of the Jobs Act during the Obama administration. Right after the Great Recession, the Obama administration introduced a bunch of different legislation to do two things at once: to loosen the ability to raise money publicly from high net worth investors, but at the same time institute a bunch of regulatory restrictions on private funds, hedge funds, private equity funds. And so we had this kind of weird balancing act at the time. We had a bunch of new laws back in 12 and 14. In 14, C came out, and it revolutionized the private capital raising industry because it allowed us to take advertising. We can go out and market publicly for a private offering. Great. But on the flip side, we are now limited to verified accredited investors. A third-party verification was what they call the safe harbor.
Now, my understanding, that accreditation is generally done either through the person's accountant or their attorney.
Licensed CPA, in the safe harbor, licensed CPA, attorney, broker-dealer, or investment advisor are the 4 professionals that can verify the accredited status for you.
That's interesting. That's good information.
Now, what's changed recently is there was a no action letter that came out recently, about a few months ago, that said, wait a minute, you don't actually have to verify everybody. So if they're coming in for a ticket size of $200,000 or more for an individual, or $1 million or more for an entity, we're going to assume that they're pretty good.
Okay.
So now you don't need to verify those types of investors anymore.
Really?
Yeah.
So that's the amount of money that they put in exempts them from
that
having
or more, right? But the key caveat is the investor must represent to the issuer, if you're the sponsor, that they did not finance the investment. As long as they add that component to it, they don't need to get verified anymore. So that revolutionizes C even further. And so a lot of our clients who are operating Bs are thinking, wait, this is now a game changer because for what we're doing.
Yeah, so for us, I mean, a $200,000 investment in PacWest is, about our, I'd say, in the middle of the road or slightly on the low side.
Right, and it also kind of makes your job easier. Like, you don't want to get verified? Well, 200 is the minimum, right?
Yeah, right.
So that has made our clients' jobs a lot easier because it just reduces the load on the sponsors day to day. But also it makes sense, right? And I think the SEC is starting to make some common sense choices right now. And that's one of them. I think they're really realizing, wait, if they're coming in for $200,000 and they didn't finance the investment, clearly they have.
They know what they're doing.
They know what they're doing. And else they meet the definition. How could they have $200,000?
Exactly.
So that's part of it. And I think that we're going to see a lot more of these kind of clarifications to the rules.
Now, the kind of work that you do, the legal part of this is creating operating agreements, private placement memorandums, subscription agreements.
Mm-hmm.
Tell us about those documents.
Yeah.
I mean, how much do they cost? How long do they take to get? Why do we need those things?
Correct. Okay, so let's start with the private placement memorandum. That thing is the most important document when it comes to offering and selling securities. It is the equivalent of what is called a prospectus. So when you buy public securities, when you go buy an ETF or buy Apple stock, whatever have you, they're going to deliver to you what's called a prospectus. It serves the same role. This document discloses the risks, it discloses the business plan, it discloses the key people, it discloses any conflicts of interest, and also discloses what we call risk factors. What might happen and what's our plan if that were to happen.
So let me interject for a second. Does the PPM also tell the investor what the manager can do and not can do?
Correct.
So for example, I'm going to give you $1 million, Mark Granger, but the PPM says you can only do loans on commercial property, sub 65% LTV, et cetera, et cetera. So that is...
It sets the tone for it discloses what the actual business plan is. And so depending on how it's written, you may have flexibility, you may not. In a syndication, a PPM will be much more narrowly written. We're going to go buy 123 Main Street. We're going to spend $300,000 on rehab. We're going to stabilize it, rent it, and sell it in 5 years. Very narrow, right? But we're also going to think about flexibility on what's property management going to look like? What's a construction team going to look like? What are our fees going to look like? We have some flexibility there usually. In a debt fund like yours, that's open-ended, the idea is we need the client to have a little more runway. We need the client to have a little more breathing room. Why? Because lending is dynamic. The market shifts constantly. We need to be flexible, so we give a lot more flexibility in those types of offerings. But the role of that document kind of serves 3 major functions. First, disclosure. Disclosure in our world, in the securities world, is the most important thing because if the investor has been deemed to have been notified of the issue at hand, then you've met your obligation under the securities laws. The second thing it does, it provides you authority, right? It gives you authority when it comes to doing certain things in the business. And the third thing it does, it provides you defense because it discloses the fact that there's certain indemnification rights, arbitration clauses, powers and authorities to restrict the investors, for them to restrict you. It gives you a line of defense when it comes to telling the investor what you can do. Under the law, these types of documents are absolutely required if you are selling even a dollar's worth of securities to a non-accredited investor, unless the state or federal government has allowed you to bypass that. There's a couple of different ranges.
So on these 25103s or this intrastate stuff, is the PPM required?
Good question. So federal law on the anti-fraud side, which is what governs the need for a PPM, trumps state law, no matter what. And so what happens here is, even in California, the state will say the same thing. If you're selling securities to a non-accredited investor on 25102F, you must have a PPM. We've actually had that debate with them. The only framework that I'm aware of that bypasses the need for a PPM and allows for non-accredited investors is that unique DRE exemption that lets you fractionalize loans.
Those are just listeners, so you know that if you have a loan for $1 million and you're going to divide it into 10 sections. Interestingly enough, the Department of Real Estate allows real estate brokers to fractionalize these things or sell securities, which is, people don't realize just how powerful that DRE broker's license is.
There's
because
nothing like it in the country. It's so unique.
It's a very unique license, and until you really get into the weeds on what it allows you to do, it allows you to sell timeshares, which are also securities.
And so that's the only one that I know of. Generally, when clients are doing, a fund or a syndication or even a fractional situation, they're not going to be in only California anymore. The unfortunate fact is that the market has become a lot larger. People have moved. The loan isn't in California anymore. That happens a lot too. And so that becomes a thing where that framework doesn't work for us anymore.
I think that the fractionalized notes, we don't do many of them. And today we're really talking about the young guy who's coming out. He wants to start doing some syndication. He wants to know how to stay out of trouble. So the PPM is one.
Then let's talk about the operating agreement.
So then we go on to the operating agreement. How are they different, and what are they?
Right. So the operating agreement is the governing document of the entity. So if you're going to use an LLC, you have an operating agreement. Way back in the day, we would use limited partnerships instead of LLCs because LLCs didn't exist. They came out roughly when I was in law school. So we would use limited partnerships. We would have a limited partnership agreement. You can choose whichever entity you like. And this assumes that you're raising equity, right? You're offering equity in the company, this newly formed company, to fund an asset, right? And so you're offering them membership interest if it's an LLC or limited partnership interest if it's an LP. From there, we need a document that governs the powers and authorities of that company formally from a corporate law standpoint. So you must have one in that circumstance. So the LLC agreement or the operating agreement will establish, primarily it'll establish the rights of the members, the rights of the manager, including the distribution rights, the voting rights, the liquidity rights, and the manager's powers and authorities in the day-to-day and also in the big picture. And it also outlines specifically like what is the procedure for winding down the company, what is the term of the LLC.
Yeah, that's an important one, guys, is do you really need to be thinking about how long do you want to hold this asset? This is something that I'm running into now, having been in the business for 45 years. I've done some syndications that were done 30 years ago, and these partnerships have, everybody wants to stay in them because they're so, they're profitable, but that's something that's a bridge that we have to cross. I assume these operating agreements can be amended.
Correct. And so that's important to think about as well, right? You have to think about these, even for a syndication for real estate, you want to think about your window. And when if you're having a project that's going to require a rehab budget or a construction budget or is going to be ground up, well, what's going to happen once you've stabilized and you've now you occupy the property? What are you going to do next? What's the time frame for the investor to come in, for you to start making distributions, and for you to start liquidating the portfolio if you're going to do it? And then with offerings like that, where you have a long-term component, is there going to, we call it crystallization, is there going to be a crystallization event where we're now switching from a gains-focused structure over to a income-focused structure, rental income, right? And so we have to plan for that.
You know, that's really interesting. Can you just elaborate? You said something I've actually never heard of, which is to switch from a gains-focused program to a income-focused program. Does that require a change to the operating agreement?
That's why future proofing is really important, right? So when we do a syndication, we ask the client, what is your long-term objective with this project? Are you going to sell it? Are you going to rent it? Are you going to hold it? What's the plan? 9 times out of 10, the client needs a little bit of flexibility. And so there's a likelihood that we're going to capture some rental income no matter what we do. And so we need to account for both. So our typical approach in a syndication is we have a dual waterfall where we capture both gain income when it kicks in and rental income when it kicks, so just cash flow income when it kicks in. So that accounts for both fact patterns. And then if you move to a long-term hold strategy, you might want to say we're switching and we're going this is going to be now the permanent, but I put it in there where it's both in there, so you don't really need to switch it over.
So you used a term in there, a waterfall. Let me just, for our listeners here, just explain a little bit on what that means. So when we were starting our syndication, I'm talking about Mark Granger, our deal was we got an 80-20 split. So 20% of the income went to the managers, 80% went to the investors, assuming that they got a preferred return on their 8%, which was the waterfall. So we had to pay the investor on their invested money 8%. As long as we hit that benchmark, then the income was split 80-20. Now, I've heard it, it's a 50-50 with no preferred. I've heard 60-40.
Oh, it's endless.
It's an endless way to slice.
There's the European way, there's the American way, there's the Asian way, there's so many different ways to do it. And
there's a million ways to slice and dice the pie, but it's important that when you start thinking about these things, that you're thinking as the manager, hey, what's this going to look like in 5 years when this thing is very, very successful? Am I giving away too much of it? Or am I keeping too little of it or keeping too much,
One other factor that people oftentimes forget in real estate particularly is that what happens when you have a big realization event? So you've either sold the property or you refied. Investors in real estate want to be able to get their capital back eventually. And now they're just going off of the growth of the investment. So you need to think about that. And then what about things like this? Well, what happens when we stabilized and we need to now manage the property? Well, if we're dealing with commercial real estate, sometimes that will require an extra layer where we may need a master tenant situation, particularly if we're dealing with hospitality.
Right.
So things like that have to be factored in when you're planning a syndication. For your average, 1 to 4 family or multifamily syndicator, not as complicated. But for those of you who are getting into, for example,
hotels,
hospitality, it's motels too. You may want to think about having a master tenant relationship so you can capture the operating income separately.
So let me talk about 2 things that I've run into as a syndicator, Kevin, that threw me for a loop. One is what happens when it doesn't work out, and you are going to the investors and saying, hey, we asked you for $1 million, but unfortunately we ran into some trouble and the investment is going to require $2 million.
Yep.
And we're doing what's called a cash call. And you go to, the 10 investors you've rounded up, and 6 of them say, oh, no problem. We love you, Mark. It's the greatest thing. We have a lot of faith in it. But 4 of them say, I don't have any more money. Then what?
So that's why future proofing is important, right? So whenever we do a real estate fund or a real estate syndication, we always want to factor in the ability to capital call. I've had sponsors tell, I will never do a capital call. I'm like, listen, man,
famous last words.
Listen, I love you for it, but you're gonna wish that you had it, right? And better to have it and not need it than need it and not have it, right? And have the ability to do a capital. And you have to think about that fact pattern, because what happens if 3 of your LPs can come in and 2 of them can't? So you have to have the mechanism. So in that situation, their capital account grows, and the guys that can't, you either penalize them or
they get a smaller piece.
They get a smaller piece because the size of the pie has grown, and the slices have increased in size for some guys, thereby shrinking your size. That's an important factor. And depending on
and it's really important too, Kevin, to tell people how this is going to work.
Oh, 100%.
Because that's when people get angry, is they say, wait a minute.
Don't tell them in advance. Well, the number one mistake that sponsors make in raising money is they don't communicate well.
Yeah. I couldn't agree with that
Failure to communicate
absolutely
has led to more lawsuits in this sector, particularly in real estate, because it's complicated and your investors may not understand. Your investor relations ground game is probably the most important thing to keeping you, more than me probably, keeping you out of litigation, keeping you out of SEC investigations. Yep. Because ultimately the SEC, they're not gonna care as much if nobody loses money. If nobody's been hurt.
Boy, that sure changes after if that isn't the case, though. If all of a sudden you run into real big trouble and you didn't do your due diligence correctly, and
poor underwriting is the number 2 reason why people get in trouble, right? So,
yeah, exactly. So another thing that has come up with me is the end of the road. You've had this thing for 15 years. It's just a stellar deal. You bought it for $2 million. It's now worth $20 million, and you're going to sell. And all of a sudden, half of your, 20% of your partners have the money in ERISA funds, IRAs or something, and they don't have a taxable event, so they're fine. Some of the other people, they just sold another piece of property. The last thing they want to do is sell because they're going to have more capital gains. And you get into this whole big, argument about when to sell. And one of the things that we ran into is some of the partners said, sure, I'll sell, but I need you to convert this to a tenant in common first so that I can do a 1031 exchange out of my share. Because remember, syndicators, future syndicators, if you have an LLC and you're trying to you're selling a share of an LLC, you can't do a 1031 out of that. You've got to convert the LLC into a tenant in common, which requires a master management agreement, et cetera, et cetera. The reason I bring these things up is that it's really important when you're doing these operating agreements in PPM, Kevin, to think about what's happening in the future events and how are those going to be handled.
Right. I mean, as a corporate attorney, my approach is typically to give as much authority to the manager as possible. So I don't want the LPs to be calling the shots on that. And listen, I got a 1031 problem. Well, that's your problem. That's my approach because I'm the attorney. I'm your attorney, so I'm not thinking about them. I don't represent them. But I can appreciate this. You're trying to be accommodating.
Well, because you want to raise more money from these people.
You got to keep them sticky. And the nice part is, compared to back in 15 years ago, now, 1031 has changed a lot. In 2017, they just rewrote the rules. But there are other programs out there now. So there are ways to defer capital gains. I would probably speak to a CPA on that issue. I'm not an expert at it. But like the ozone program, it's been made permanent, right? So that's a really good solution to now take your gains from a syndication and move it on to something else that will let you defer. There's 721 exchange. There's UPREITs. There's all kinds of unique structures out there besides going to a TIC. I would not ever advise a client to move to a TIC. It's too much work. Yeah. And also, like, there's the risk on your end, and it's just.
Well, what happens as a manager under those, and we're digressing slightly, is when you get into these TICs, then the management of the TIC partners, if you will, gets very, very complicated. And if somebody holds you up or, they die and now you're dealing with their estate, that's another thing, by the way. Oh, yeah. You start dealing, if you're in one of these, if you've syndicated one of these things, if you've syndicated a piece of property and you've owned it for a very long time, more than likely you are going to have partners that you did not start with.
Yeah.
And by the way, syndicators, remember this, in the state of California, I believe the rule is that if 51% of the original investors are gone, you are resetting the property taxes, aren't you?
You are. Yeah, you have to do a resurvey on the property. Yeah. Yeah. And that's really unfortunate. And so that's where I tell the client, like, I don't love the idea of you like going for super long. I prefer the client to be in within 10 years, ideally be out or rolled up into something else.
Yeah, one thing.
Estate planning issues are a nightmare.
Yeah, we've run into a lot of that. One of the things that we've done in our operating agreements, just as a tip to syndicators out there, is that what we say is that if shares come up for sale, they can be only purchased initially by the remaining partners. Correct. So what you're not doing is you're not transferring the ownership anymore. It's
Right.
just you're just giving everyone else a larger
a right
piece of
first
pie.
refusal
Yeah,
on the-
right,
yeah,
exactly.
And that's important. Yeah, you need a plan to deal with estate planning issues, especially in syndications and funds, because the target investors are usually older.
Yes,
And
exactly
it's
right.
just a mess if you don't deal with it correctly.
I have run into, we are dealing with that as we speak on a number of partnerships I've put together. Okay, so question for you. Where do you see people getting into the biggest, where are they getting into trouble on these things? They're just not doing what we're talking about, or they just don't understand it? Or
Yeah. I mean, there's two camps, right? There's the kind of the ignorance camp, or they just don't know any better, and they see their friends do it, or they're in a RIA, and they kind of get bad intel, and they just run with it, and then make a mistake, and they get hit by a regulatory action, or an investor complains to a regulator, and they lack a PPM, no disclosure, the waterfall.
so what they do is they just form an LLC.
Yeah.
They tell, Fred, Joe, and Sam to put money into it. And it's just they don't even have a subscription agreement. They just
buy
put the money in.
template from some RIA group, and they just run with it.
Yeah.
And it's just a hot mess. That's a very common mistake we see out there. Like, honestly, like, even if you're not going to use me, like, there's a lot of attorneys out there that do this professionally, and it's very affordable now. That's one camp.
So that's a good point. You brought that up. How much does it cost to do a PPM operating agreement, subscription agreement? It's a $2 million deal.
Yeah.
We're raising $1 million. What?
I mean, it can be as low as, starting prices on our side can be as low as $15,000 to as high as, depending on the project, right? If we're doing the larger the file or the more complicated the file, the more expensive it gets, right? So, we have projects right now that are upwards of $100,000 because they're complicated REIT structures.
And there's lots going on.
Lots going on, right? So,
but for the for the standard
syndicator,
Camry model,
anywhere between 15 and 30,000 is kind of where you want to be, and that cost is expensible, right? So it's expensible to the LLC. It's a formation cost, so you can amortize it over the 5 years or 10 years or whatever and earn it back, right? So it's an expense worth taking because the cost of not doing it is legal fees alone. You're probably just on hourly billing, $50,000 to $100,000 because
once you get into it with these agencies, you are just
it's just endless.
It is endless,
right? And the time it takes to defend it is significantly more than it takes to prepare it. So that's saying of like an ounce of prevention, right? So, but the other camp is something that you don't see it coming, and it's more and more prevalent out there. We see it in real estate. We see more of it in kind of the creative finance world. Is, for lack of a better word, fraud. And the sponsor is typically not the one that's actually committing the fraud. They are investing in a program that is fraudulent. So there are programs out there that are like, oh yeah, we'll help you raise money, or we'll let you post your deal with us, or we'll some of them are even, we'll back office your offering. Some will say, we'll bring you the deals, and they're just fraudulent. And or they're asking syndicators to say, hey, be a syndicator of a syndicator or fund of fund. And
so you're raising money for someone else's project, and you're getting a piece of the
action, and it's just outright. And the sponsors have no way of knowing. And because
when you use the term sponsors several times, Mark Granger goes to his 5 friends and said, hey, I ran into this guy. He's got this, car wash somewhere, and it's just printing money. And he wants to raise $10 million. I've signed up to raise $2 million. Yeah. And you go to your 5 friends and they each put in.
And you're the sponsor in that.
You're the sponsor in that case. And you upstream this $2 million to the guy you met. And it turns out that what he really likes to do is spend a lot of time in South America, and your money's just gone.
In the worst possible case scenario, that's what happens, like a straight up Ponzi scheme or straight up just completely fraudulent use of proceeds. More often than not, it's a little bit more nuanced. It's an actual program, it's a legitimate program, but just a poor quality, operator. And And then they just lie to everybody. I've seen both. And on your side, what you don't realize is that, now you are in the business of A, selling securities on behalf of others, the car wash program. B, you are in the business of pooling money and buying and selling a security that he's offering. So now you've accidentally triggered the Investment Advisor Act and the Broker Dealer Act. And so just the amount of headache that comes with all of this, and you're probably in protracted litigation trying to recover because this guy is
and
being
the
investigated.
investors, you know what, when things go south, they look to you.
100%.
They come after the sponsor and say, hey, I trusted what you told me,
Right.
and now it turns out my money's gone, and I need that money.
Right.
Yeah,
And
so-
I just tell people, like, if you're doing some kind of like deal of a deal kind of raise, pump the brakes. Talk to an attorney. Talk to an experienced securities attorney, because they are complicated structures. And I've been licensed now for almost 20 years. I can smell it a mile away. I can see it. Wait a minute. No. You need this, and this. I don't see any of this anywhere. Stop.
Yeah.
And it's easy to tell.
So we really want, the goal in this podcast today is to tell you how to do it correctly, and just a few things to watch out for. We're just tip of the iceberg here with this stuff, because there's a million ways to get yourself in a serious jam. They're shifting tons of risk towards you. What about, follow-up question, financials on, so you formed the LLC, you bought the property, you're starting to do financials. What's your view on audited versus non-audited financials? Pacific West Mortgage Fund has been audited since inception, even when we only had $3 million under management.
Right.
It was required, by the way, with the intrastate fund that we were doing. It's no longer required, but we continue to do it just because I think it's a good idea.
Yes.
But practically speaking, if you're buying a 16-unit building for $3 million and you're raising $1 million, is audited financials, are they really?
Not. Yeah. But I would tell you, though, even those kind of guys, one area of litigation, but also for regulatory mishaps, has been valuation models, right? So failure to follow GAAP accounting on how you're valuing the portfolio can be a source of risk and liability. So having CPA reviewed financials at the bare minimum, if you're a syndicator and you're doing deals that are, I would say, sub $10 million, sub $20 million at least, you don't necessarily, legally you don't need it, right? But you may not need it because the deal is too small. $5 million or less, it doesn't make any sense to do.
Well, it's expensive. Just to let you know, listeners, an audited, to get even the most basic audit, is around $25,000 or $30,000 a year right now.
So it's just not worth, and it takes a long time. So it's not necessarily worth it if you're doing a $1 million deal, but at the same time, you should have a CPA, because the thing is that, and I've seen litigation around this, if the sponsor doesn't correctly run what's called net asset value of the portfolio of the one property, you could be accidentally misstating the capital accounts, and if you do that wrong, technically you've misrepresented the value of the investment. And
Right,
so
exactly.
it's important to think about tax and accounting as a must-have. And there's so many good small CPA firms out there now, because there was a mass exodus from the Big Four, and a lot of them are now running small outfits, and they're great.
And so, they love this kind of business.
Oh yeah, and
Yeah.
so there's no
Yep.
excuse in that regard. Now, once you're running a fund, my perspective, I don't really care how small the fund is. I am a firm believer that audited financials take you so much farther when it comes to raising money than not having it. Any sophisticated investor, even the high net worth guys that I know who invest in these things, tell me, Kevin, if they don't have audits, I'm not going at it. I'm not looking at it.
I'm not even looking at it.
I'm not looking at it. And that's, to me nowadays, there's so many funds out there, it's become table stakes. And so it's to me, it's a best practice and almost a must have. Even if you're running a private offering, even if you're raising only 10, 20 million, you should still do it.
So let's talk about insurance for a second for the syndicator. E&O insurance, you think that's important?
It's the same thing with audit, right? It becomes a question of cost, right? So I would probably have, if the management company, that company should probably in the long term get E&O. But if you're doing your first deal, the premiums don't make any sense because these are custom premiums.
I have found the problem with this E&O insurance is that you start looking at these policies, and we actually had a podcast on insurance, but you look at these policies and they just exempt everything that you do. So you're paying this money, but you're not getting anything for it. So
I actually like D&O better than E&O.
What's
Directors and officers insurance.
Okay.
And it's more like malpractice insurance for the actual officers and directors. And I find that to be a little more valuable. They're less carve-outs. The premiums are similar to E&O. And that's the problem ultimately. brass tacks, it's just too expensive for if you're doing your first syndication, it costs too much.
Yeah. I was going to say, Kevin, I think one of the things that we're talking about, I'm sorry to interrupt you, but just one of the things to keep in mind, listeners, is that we've gone across a lot of acreage here, if you will. A lot of this gets down to how big a deal you're doing,
100%.
right? So when I started our thought experiment, we're starting with a really small deal. You're going out trying to raise $1 million, which is a lot of money, by the way, and it exposes you to some serious risk unless you do it correctly. But let's face it, you can't take on, hundreds of thousands of dollars of professional overhead to do it. It just doesn't make sense.
Right.
I would, correct me if I'm wrong, but I think a lot of things like, D&O and audited financials. I mean, you really have to be up to like a $10 million threshold.
And even syndicators who are doing bigger deals, they tend not to get audited financials because it's one asset, right? So the auditor will tell them, like, I'm just auditing that one asset. Like,
there's nothing to talk about.
There's nothing to talk about, right? So, but if you're doing a fund with multiple assets, then absolutely, right? So that it's a practical issue from that respect. And I find that in syndications, most investors don't insist on it, and so that's a factor to consider as well.
So, one thing I talk to younger people getting into the syndication arena, they're like, well, should I do a corporation, an S corp, a C corp, an LLC? From a legal standpoint, how much protection do those organizations offer the sponsor, the guy putting it together?
Well, they all provide what's called limited liability, right? So the idea is that if someone sues the entity, if everything's done correctly, they can't go after the owner's individual assets. That's the purpose behind these entities from a legal standpoint. But a lot of people forget that there's this thing called alter ego liability or this thing called piercing the corporate veil. So whatever entity you choose is really more of a tax issue than it is a legal issue. All of them are good, right? But when it comes to the liability protections from a corporate law standpoint, you really have to make sure that you're running it correctly. Like, it has to have its own bank account. It has to have its own tax returns. It has to have its own, I should call it books and records. Like, it
and
has
don't
to be,
borrow money from the LLC. If you're the sponsor and you need a new car, don't tap into the LLC's bank account, right? I mean,
so
that's
the idea of like commingling funds. Are you and your entity one and the same, exchangeable? That's important, right? And so, from my perspective, following the necessary formalities, having actual, like bylaws if you're a corporation, an actual operating agreement, resolutions and minutes, and all those little things that may seem like, it's by myself. But that's the thing that kind of keeps you out of the argument that, hey, you too, entity and you are one and the same, therefore I can sue you individually and go after your assets.
Exactly right. So that's what you're trying to avoid. Yeah. This is really deep into the weeds, and I'm interested personally on this. So these LLCs were all created, as you said, they didn't exist until whatever it is, 20 years ago. They were done under the Beverly-Kalia Act. Yeah. So that no longer exists, I understand.
Now it's the Uniform LLC Act,
It's the Uniform LLC Act. Yeah. So that's how it's done now.
Yeah.
So I have operating agreement, PPM, that has reference to the Beverly.
It's okay. Yeah.
It's not a big deal.
Not a big deal. I mean, you should probably change it when you get the chance. But the thing is that it replaced that code, so it's okay.
It's not
your documents probably say comma as amended, and that's what happened, right? They amended the Beverly-Kalia LLC Act or replaced it with the California Uniform LLC Act.
Okay, so now we're going to supersize this a little bit. You have mentioned, I know that you've sent material out to me on this. There are some big changes in the REITs from this big, beautiful bill, I understand.
Correct.
So tell us about that.
So this applies to real estate and mortgage, right? So back in 2017, the Trump administration passed the Tax Cut and Jobs Act. That extended a 20% pass-through deduction for any pass-through business that qualified.
So you're going to have to explain this just a little bit.
Yeah, so
So I'm an investor. Mark Granger's come to me. I've just given him $200,000. And he's now formed, instead of having an LLC, he's transformed that into a REIT.
So I'm getting there, yeah. So the idea behind the trend in the REIT world has been this 20% deduction. The 20% deduction was eligible for a lot of any pass-through entity. So the LLC, LP, they're all pass-throughs, right? The problem was the code was written in a way, two problems. First, it was deemed to sunset at the end of this year in the original code. And then the second part was there's a phase out on income, on your tax bracket, on ordinary pass-through businesses. But the code was written, interestingly enough, that qualified REIT dividends had no phase out on your tax bracket. So you can be making well above the top tax bracket and still claim that 20% deduction. So what was interesting was, well, this is a very good reason to start thinking about a REIT, because REITs, now we are all pass-throughs, right? All the syndications and funds are pass-through entities. The problem was the investors were all high net worth investors, well above the top tax bracket. So they weren't going to claim it. They weren't able to claim it on its face. So funds in particular started thinking about, well, this qualified REIT dividend doesn't have a phase out. Let's convert our fund into a REIT. So from 17 to 20 this past year, we did a lot of work of converting debt funds and real estate funds into REITs because investors wanted that deduction. For real estate funds, it's a little more complicated because real estate requires you to have a certain threshold of rental income, whereas mortgage funds don't. As long as everything's a mortgage, you're fine, right? So that was the trend. And then the One Big Beautiful Bill Act made that 20% deduction permanent. So now we don't have to worry about it going anywhere. So it continues the eligibility for that 20% deduction. But on top of all that, that's the big driving factor, right? That 20% deduction is a very important, meaningful thing, particularly in real and mortgage funds, because it's all ordinary income, right? And so what it does is, well, I get a 20% pass-through deduction now, regardless of my tax
So how
bracket.
does that work exactly? Explain that to me.
So let's just say, for example, you have a $1,000 distribution, right? Instead of paying taxes at ordinary income rates at $1,000, now you're paying taxes on $800, right? A straight line.
What about the 20% then, or the 200?
Deducted, straight deducted.
Really?
Yeah. And so if you're in top federal tax bracket, you're at about 39.
So that's a huge deal.
Huge savings, which is why you saw all.
Why aren't we doing that right now?
That's why I've been talking to you about it, right? So a lot of the big funds out there shifted over immediately. In 17, they're like, oh, we want this, we want this. The trend started to fizzle out because of the phase out in the sunset in 2025. Now that we know it's permanent, I feel like any fund that's kind of, any debt fund that's kind of over 20-ish, 30-ish million should really think about it. The funds.
And what is the cost to do that?
It ranges depending on the complexity, but like we can do them anywhere between, on the low end, probably in the 30s, on the high end, in the 50s, depending on the complexity.
So I always think of REITs as publicly traded REITs.
Yeah, that's a myth. Yeah.
So you can do a REIT structure even as a private fund.
Correct. And there are additional rules for public REITs. As a private REIT, we're just doing this for tax strategy, and there are consequences. There are a lot of consequences of becoming a REIT. There's testing obligations, there's asset testing, you have to dividend a certain amount of income.
Right. Isn't it something like 95% has to be distributed?
90% or more must be dividended out, but we can solve those problems through structuring. For most lenders who are balance sheet lenders, where they just hold all their loans and they have some moderate leverage.
Like Pacific West, that's what we do. So,
and you don't really, you don't sell any loans, you don't do any weird loans like what's it called, like operating income participation. You're a great candidate, and most of the balance sheet debt funds out there have gone in this direction.
Interesting.
And are still doing it today, right? And so it's a very good option. It's complicated. Tax law, corporate law. So you want to make sure you're navigating it correctly with an expert. But it's definitely something worth doing because of 20%. And for the real estate operators, if you're running a fund structure and you're primarily doing like income producing properties.
So this would be, just for our listeners to catch up here. So let's say that you're a real estate operator and your model is you raise money continuously, and then when you get up to a certain threshold, you go out and buy an industrial building or you buy an apartment building or whatever fits your model. And each one of those apartment buildings is done in an LLC, a separate LLC.
Oh, syndications, okay.
Yeah,
okay.
so it's just like sort of a, but the global thing is one master fund. Is that?
So there's a couple things there. So if you're a syndicator, and many people prefer syndication, right? And you're at that stage where like, okay, we're at that stabilization. We're just getting rental income now. I've had many discussions with syndicators. They're entertaining a roll up, right?
So they take all these. They got 20 LLCs, individual LLCs with different properties, and they roll all of those into one REIT.
And so we can avoid capital gains by doing a 721 exchange by just contributing.
So that's what that's called,
right? And we can do it's called an UPREIT structure, right? And you can do that, and that will allow you to kind of pool the capital into one structure. It's a fund structure. It can be closed-ended. It doesn't have to be open-ended, and it'll get the tax benefits of being a REIT. It really, in real estate, it only really works best if you're in a portfolio of income-producing properties.
right?
If you're in a portfolio of operating income-producing properties, though, you have to be careful. So if you're doing hospitality, if you're doing
Because you have unearned. What is that?
it's not unearned. The issue is operating income is not conducive. It's considered bad income for REITs. And so, like for example, senior housing. Hospitality, some short-term rentals. Those things can produce what's called operating income, but it's solvable. It just requires some extra layering.
Yeah, I assume what you do is you kind of divide the income from the property to the operating portion of it.
Exactly.
So, Kevin, you spent an hour with us. This has just been an immensely interesting conversation. I could spend hours talking to you about this. I'm not sure how many people could listen to it, but it's sure interesting to me. Fortra Law, you're down in Orange County still.
Correct.
And you have quite a good team down there.
Oh,
you
yeah.
have 4 principals, 6 principals.
So there's 7. Hold on. There's 6 of us on the partnership side, and then there's 4 owners. So that there's a lot of us now, and total firm size is about 100 people.
So we, listeners, we will have Kevin's contact information. If you are thinking, the reason I'm doing this other people's money podcast is because we're starting to see real estate values slide into the position where things are starting to get interesting again. I know a lot of younger people are interested in starting to build their wealth and portfolio, and they maybe don't have all the money in the world to do it, and they want partners. All I would caution you about is just do it in the right way.
100%.
So Kevin's here to help. We have his information on the Pacific West Mortgage Fund website. Please go there and check it out. And Kevin, I hope that we can have you back again.
Happy to do it.
It's really, really been a pleasure to see you.
Thank you for having
so
me.
thanks
It's been a
very
fun
much
time.
for coming all the way up and seeing us.
Thank you so much.
Thank you.